In this video, we got you on how to buy your first house with an FHA loan in 2023. But before we start, please like and subscribe to this channel and then sit back and relax. Although owning a home has long been regarded as a component of the American dream, it has grown more challenging to realize in recent years. This applies to the millennial generation. America's greatest generation faces obstacles to home ownership that are challenging to overcome, such as high student loan debt and rising rent in urban regions. But there are solutions available to first-time homebuyers that might make the dream of owning a home much more attainable. Even if your income or credit score is low, the U.S. Federal Housing Administration offers mortgages that are simpler to qualify for. Although not everyone qualifies for an FHA loan, 83% of the 1 million mortgages guaranteed by the FHA a few years ago were for first-time homebuyers. So, if you've been wondering how to leap from renting to owning your property, you are in the right place. Benefits of an FHA loan. FHA loans are attractive to first-time homebuyers for many reasons, including lower interest rates. When compared to conventional loans, FHA applicants frequently receive lower interest rates. Flexible credit requirements. Because the loan is backed by the federal government, lenders may have more flexible credit requirements. You can be approved with a score as low as 500. Smaller down payment. FHA loan down payments can be as low as 3.5%, but the typical conventional loan demands a down payment of at least 20%. While there are many advantages, you need also to consider some drawbacks. For instance, insurance costs for FHA loans are greater than those for conventional loans. Facts about FHA loans and the amount you can loan. The Federal Housing Administration was established by the U.S. government in 1934 as a response to the economic hardships of the Great Depression. This program's objective was the same as it is today, to provide low-income borrowers with a chance to purchase and own a home. As a federally insured program, there aren't many differences between states in terms of applying for and being eligible for an FHA loan. Nevertheless, there is one significant distinction. Depending on where you live, there are different borrowing limits. For instance, the maximum FHA loan amount for a single-family home in Hillsborough County, Florida is $314,827. Borrowers can apply for loans up to $726,525 for a single-family house in more pricey areas like Los Angeles County, California. Why is such a big difference? The average selling price of the homes in a certain area determines the loan ceiling. The average house in Hillsborough County costs roughly $221,000, while the average house in California costs about $790,000. You can enter the name of your state and county into HUD's official FHA mortgage limit calculator to learn the FHA loan limit in your area. A loan limit, however, is simply that, a limit, regardless of where you reside. Most first-time homeowners won't be able to borrow the full amount allowed in their county. Your annual income, your debt-to-income ratio, and the size of the down payment you can make are just a few of the variables that will determine how much you may be eligible for. Online loan limit calculators aren't always accurate, especially if your income isn't consistent or traditional. So, you need to talk to a local mortgage professional to get the best idea of how much you can borrow. How do I qualify for an FHA loan? You must be at least 18 years old. You must possess evidence of your revenue, like tax returns, pay stubs, etc. The house will serve as your main residence. You have a debt-to-income ratio that is less than 50%. Lenders may have different minimums. There is more to whether you are eligible for an FHA loan than a simple yes or no response. Although these loans are government-insured, keep in mind that they are made by private lenders. Find a local FHA-approved lender by doing your research to learn about their loan criteria, mortgage rates, closing costs, and other fees. What about my credit score? You may be thinking at this point, what credit score do I need to qualify for an FHA loan? As we have explained, one advantage of an FHA loan is that even with a low credit score, you can still get approved. Yet, the type of loan you are eligible for is still significantly influenced by your credit score. For instance, you can be eligible for 3.5% down if your credit score is at least 580. You will need a 10% down payment if it is less than 580. In other case, the down payment is still considerably less than the typical 20% down payment for a property with a conventional mortgage. If your credit score is below 580, it's worth spending some time trying to improve your score before applying for an FHA loan. Not only will you be able to qualify for a lower down payment, but you could also qualify for lower interest rates depending on your lender. How to apply? 1. Find a lender. The first step in the process is to contact a local FHA-approved lender. You may choose to work with a direct lender, such as a bank or a private mortgage broker. Unlike a bank, mortgage brokers like Associate Home Loan of Florida have access to a large group of lenders and loan programs to help you get the best result. 2. Get pre-approved. Although it is not a necessary step, getting pre-approved makes the application process easier and shows home sellers that you are a serious buyer. 3. Complete the application. To complete an FHA loan application, your lender will need your social security number, verifications of employment, tax returns, appraisal documentation, a credit report of all borrowers, and proof of previous rent or mortgage payments. Understand the true cost of a house. Just because it's easier to qualify for an FHA loan than a traditional mortgage doesn't mean that this type of mortgage is right for you. There are many things you'll want to consider before applying, including insurance payments, closing costs, and any additional fees. Sure, mortgage insurance is a requirement for FHA loans with down payments under 20%. You will have to pay two different kinds of mortgage insurance premiums. The first is an upfront fee that is 1.75% of your loan balance. The second kind of MIP is yearly and typically amounts to 0.85% of your loan balance. Depending on how long your mortgage is for, your annual MIP could be more or lower. For instance, you might be required to pay up to 1.35% annually on a loan with a 30-year duration. However, recent rule change ensures that mortgage insurance payments will continue to be costly throughout the loan. Before June 3, 2013, you could cancel your MIP payments once you met the following requirements. It must be at least 22% equity in your home. And if you had a 30-year mortgage, you were paying it off for at least 5 years. 15-year mortgages did not have a 5-year minimum. Closing costs. Installments are a necessary evil of any type of mortgage. FHA loan closing costs are not that different from closing costs associated with conventional loans, but there are some differences. The MIP down payment equal to 1.75% of your loan listed above is an additional cost unique to FHA loans. Many borrowers choose to include the expense in the total loan amount. Together, the MIP down payment, administrative costs, application fees, and other loan-related costs can add up to 3 to 6% of the home's purchase price. Since closing costs vary from lender to lender, you may want to shop around to get estimates from multiple lenders so you can get the best possible rate. If it's within 30 days, multiple lenders pulling your credit won't affect your score. The hidden costs of owning a home. When trying to decide if an FHA loan is right for them, many people make the mistakes of only planning for loan-related expenses, like insurance and closing costs. But first-time buyers should be aware that owning a home comes with its fair share of unexpected costs, such as property taxes, maintenance and repair, and utility bills. Tips for paying your down payment. One of the most difficult parts of the mortgage application process for first-time homebuyers is finding enough money for a down payment. While FHA loans require much lower down payments than conventional mortgages, which is 3.5% or 10%, can be a big expense, especially for younger buyers who haven't had time to build up their savings. Fortunately, the Department of Housing and Urban Development is somewhat flexible when it comes to acceptable down payment sources. In addition to money in a checking or savings account, you can also use cash on hand, stocks and bonds, retirement accounts, and endowed funds. It is not uncommon for parents, in-laws, and other relatives to donate funds for a down payment. If they don't expect a refund, then money can be used to cover the full cost of a down payment on an FHA loan. Just because you can use a family gift to cover 100% of your down payment doesn't mean you should. If you enjoyed this video, don't forget to hit the like, the subscription button, and the notification bell. To get notified when new videos are uploaded from this channel, please share your thoughts about how to buy your first house with an FHA loan in 2023 in the comment section below. Thank you.